This is an uncovered Japan company research report on Minato Holdings, ticker 6862. It is a Japanese small cap that combines industrial memory modules, ROM programming services, IT hardware distribution, and an acquisition-led digital consortium strategy. Minato's starting snapshot is unusually sharp. The report puts the forward PE at 6.6 times, alongside a fiscal 2026 return on equity of 30.1% and an 11.6% operating margin. The balance sheet equity ratio is lower at 25.2%, reflecting acquisition-led asset growth. The low multiple is therefore not a simple quality discount. It is the market pricing a volatile cycle. Minato is not one business. It makes industrial-grade memory modules for equipment that must operate reliably for years, programs firmware onto chips, distributes conferencing hardware, and adds acquired digital businesses. The important economic fact is concentration. Digital devices supplied 61% of fiscal 2026 sales and roughly 81% of group operating profit. That makes the memory cycle central to the investment case. The segment mix shows why Minato's results can move so sharply. Digital devices is the largest and highest profit contributor. Digital engineering is smaller, but its 12.6% margin includes a specialized ROM programming activity. ICT products add steadier distribution revenue at a lower margin. The mix provides some diversification, but the group is still driven by a memory business whose profits are sensitive to pricing. The report places Minato's most durable differentiation in digital engineering, rather than in memory resale. Through Minato Advanced Technologies, it runs a Samsung and Toman-linked ROM programming operation for domestic electronics makers. The work combines validated firmware writing, handling, and quality assurance, capabilities that customers cannot replace with a commodity purchase. A new Yokohama plant expanded capacity, while industrial customers value long continuity of supply. The financial chart captures the opportunity and the risk. Fiscal 2026 revenue reached 36.6 billion yen, and operating profit reached 4.2 billion yen as memory prices rose. The operating margin moved from 3.1% in fiscal 2025 to 11.6%. That operating leverage creates the striking return numbers. But it also means investors need to distinguish a structural improvement from a favorable point in the memory cycle. Cash flow is the critical counterweight to the income statement. Fiscal 2026 operating cash flow was negative 6.1 billion yen, reflecting a working capital build as the business grew. The report does not describe this as an immediate earnings quality alarm, but it does make the balance sheet and inventory cycle important to watch. Strong accounting profit does not automatically become free cash flow in a rapidly expanding hardware business. Minato's 30.1% fiscal 2026 return on equity looks compelling, yet the accompanying balance sheet trend needs equal attention. The equity ratio fell to 25.2% as acquisitions and working capital enlarged the asset base. This is not a net cash compounder. The scorecard should pair return on equity with cash conversion, funding discipline, and whether acquired businesses deliver the promised synergies. Management's strategy is to assemble a digital consortium, buy or ally with specialist technology companies, and create cross-selling opportunities. The report notes a record of acquisitions and says the midterm plan 2027 is ahead on progress against its revenue and profit goals. The intended benefit is a larger service layer around hardware. The corresponding risk is clear. Integration, financing, and impairment become more consequential as the group grows. At 6.6 times forward earnings, Minato trades below its 5-year average multiple of 11.5 times. The report's key insight is that this discount is structural as well as cyclical. When earnings rise, the multiple compresses. When earnings fall, the multiple expands. Investors are not simply overlooking Minato. They are discounting the durability of peak profits, small cap illiquidity, and the volatility of the memory cycle. The report's own illustrative 3-year scenario range runs from 1,700 yen in the bear case to 5,600 yen in the bull case. With a 3,000 yen base case against a 1,920 yen reference price, this is not a forecast or recommendation. It is a way to frame what matters: memory pricing, execution of the midterm plan, cash conversion, acquisition discipline, and whether the programming franchise broadens beyond a concentrated relationship. To conclude, Minato Holdings combines a differentiated ROM programming service and industrial customer relationships with a highly cyclical memory profit engine. The valuation is low, and the strategy has momentum, but the risks are visible. volatile earnings, working capital demands, leverage, and small cap liquidity. The useful scorecard is simple. Follow memory pricing, cash conversion, acquisition discipline, and the durability of the programming franchise. For a much deeper look, visit the free deep dives at uncoverjapan.com. We go beyond the headline numbers to cover the business, financials, valuation, risks, and catalysts. This video is for information and education only. It is not investment advice or a recommendation to buy or sell any security. Always do your own research.